Hey, welcome to Money Mavericks. I can't even remember what our show is anymore. No, we love market makers, and we have a market maverick with us, a legendary one, Sam Stovall, of whom has graced our show for years. And I was just talking before we got going. So I'm a little confused. We don't talk politics here unless it affects the actual economy. But I was all ready for Sam. I was all ready for the first day out of the first day of the presidency. All right, here's the 25 or 50% tariffs against China and Mexico. And oh, by the way, we just renamed the Gulf of Mexico, Gulf of America. I mean, I expected all that sort of headline stuff. Seems like somebody's talked him off the ledge a little bit. Sam, am I dreaming here?
Well, no, I think that a lot of that was not introduced in his inaugural address.
Yeah, that's true.
But certainly you did have some reporters ask questions. Well, what about the tariffs? And he said, sure, we'll do 25% on Mexico, Canada, and China. When will you do that? Probably February 1. And then it was asked again, and he reiterated it. So it's certainly that's still in the cards right now.
And I know you wrote an article about this morning, which I unfortunately did not read because I want to get it from the guy. I don't. Our viewers want it straight from the horse's mouth, as it were.
Thank you.
I've interviewed Mr. Trump many times for FBN, and the producer, when I first met him, said, first off, don't shake his hands, and then secondarily, take it seriously, not literally. And so I have used that as sort of understanding how this is going, number one. And then number two, he was president for 4 years. He learned a whole bunch of stuff. This time he actually knows, what he's doing, where the bathroom is, and, what a bill is and where the pens are hidden. And so I'm optimistic. How about you?
Well, I think so as well. I mean, just take a look at how the market has performed leading up to the inauguration. The S&P was up nearly 4% from election day through inauguration day. Normally, it's up only about 1.5%. So I think investors were pretty optimistic. Certainly, we shot out of the gate early on with the Bitcoin going up, with small caps surging, et cetera. Then we ended up giving back some of that as the Fed was a little too hawkish. And as a result, investors started taking profits before year end. But I think in general, Wall Street is fairly optimistic that he will be reducing regulation and pushing toward increased earnings.
Yeah, I also, excuse me, I also think that the regulation issue is really a large issue. If you look at these large companies, which I was just in one yesterday, won't be named, their M&A department, there's like 50 people there. I mean, they need to do something. And they felt like, basically they've been chained to the desk for the last 4 years. And so I would expect to see, and maybe the Google case is going to be one that will, be the harbinger of change. But I expect to see, I mean, first off, we're long, banks, we're investment banks, we're long Goldman Sachs and JP Morgan and Morgan Stanley, and Jefferies, as a matter of fact, because they do a lot of IPO stuff. But I expect to see these IPOs start to hit. I expect to see some big, acquisitions coming. And then, the leaders are just leading again. I mean, you saw Netflix come out today. Oh, gosh. We only beat our numbers, by, I don't know, 11 or 12%, but we're raising our prices. The television, the viewers for our sports, our professional sports, has off the chain. And now, finally, it looks like they're actually going to charge the right amount of money for advertising. Because when we were going to advertise it for this show and other shows on Netflix, on their ad channel, Sam, the prices were like 3 times what it is for YouTube. So I think they got somebody in there and said, hey, wait a minute, let's actually get some advertising revenue here. And they're going to probably show $3 to $4 billion. And that is all incremental profit. There's no cost to it. You pay a broker the, whatever fee, and that's it.
Well, yeah.
I'm not seeing bad news, Sam. I want to be namby-pamby here, but I'm just not seeing a lot of bad news.
No, you're absolutely right. And when you just take a look at the earnings for the diversified banks, expectations were for about a 36% year-on-year increase in Q4. Now the expectation is closer to 60%. And that's not even with the IPO activity that's likely to be blossoming as we head into 2025. So right now, I think things are looking very strong for the financial sector. And that actually played in quite nicely because usually in the beginning of each year, I have investors say to me, Sam, should I buy last year's winners or last year's losers?
Hey,
My
Sam,
answer
Sam,
is,
should I buy this year's winners and sell those losers?
did you? Well, the question is, which one should you do? And I say,
Yeah.
the right answer to most financial questions is that depends. So following a
What are
down,
you, an economist now on this hand? This is the other hand?
following a down year, you want to own last year's losers because they have the greatest upside potential. So you want to rotate out of those that were first into those that were worst, or as you like to say, from foist to woist. But following up years, you actually want to be letting your winners ride. And so whether you look at the best performers in 2024, communication services, consumer discretionary, financials, and tech, it's like talking to Captain Reno from Casablanca when you say which were the best performers since election day. You round up the usual suspects because it was those four groups. And that's one reason why financials is still overweight recommended by us at CFRA.
Well, I'm with you, brother. And if people come to transformativeresearch.com, hopefully our system is back up working today. But we have been, for the last 2 years, basically, long what we call the AI tech stack. And, just even today, the news from, Oracle coming out now for CBS News had just an hour ago saying that they're going to be building huge data centers with $100 billion of somebody's money, SoftBank, but they really looks like it's going to be 300 billion. There's only certain places you can build those, Sam. Now, I lived in D.C. for a long time, and every once in a while we'd go down to that part of Virginia where there's 18 data centers. Literally, it was the place where the cable came in from Europe for the internet back in the day, and it was in Herndon, Virginia. I've been in dozens of these things. They're noisy, they're loud, they suck a stupid amount of electricity. But we're going to be building about 70 to 100. And at about 500 million a piece to $1 billion a piece, depending how that is. So you go down that whole chain of what it takes, and it starts from the people who own the land. So we've owned this silly little company called Texas Pacific, TPL, which has 190,000 acres of Texas land. Funny they call it TPL. And it's sitting right in the Permian Basin, so they have literally free gas, net gas, because they don't capture it all. If they didn't let it go, because they can't do that anymore, they got to put it somewhere. So now they're going to put it in tanks. All the way up the chain, this announcement just came out about 2:00 today, and I'm just looking at our screen here, and oh my gosh, that's like a 9% day. Sam, I'm basically going to quit today. It's done. Other than the tech stack, though, what do you like?
Well, our three main sectors that we have overweight recommendations on are communication services, information technology, as well as financials. You were talking about, at first it was Netflix, then it went to tech, then it went to energy. So I feel like
you know how I roll. I have
conscious.
attention deficit disorder.
Are you related to Faulkner? In terms of technology, we're still overweight there because of strong EPS growth. We're looking for 20% growth in 2025 and 2026, outpacing the market, not surprisingly.
Yeah.
We're expecting the group's semis, software, hardware to continue to lead the pack. Cloud growth is expected to be continuing, higher CapEx spend, AI revenue to outpace the AI spend, which is something good. And then you've got very strong free cash flow and a strong balance sheet. So lots of reasons to stick there. A lot of those are the similar reasons for communication services.
Mhm.
And then as financials, as I mentioned to you, basically a lot of reasons why you want to stick with those. But it's also the thought about, well, what do you want to be avoiding? And it's, essentially the defensive areas of the market,
Mhm.
in particular consumer staples and healthcare, because investors are going to go for the growth. And these three sectors that I just mentioned are the ones that have the growth.
Every once in a while, I feel sorry for my value investing friends. And for the last 3 years, I've tipped a few Irish whiskeys with some of them. Um, and I still, at the end of the day, after the two strengths, the two gin and tonics are down, I'll say, X, what is value when you have a transformational technology, global transformational change? By the way, that's what my company is about, transformative change. Okay. So how do you buy value when clearly these global giant waves of transformation and technology transformation are all happening at the same time, and there's an entire chain? How can you get on television and say, yeah, but the price earnings ratio is higher than the average PE, and so I'm not interested. And then I'll say, well, what did you do last year in return? And if you look it up, like one of these major people I won't name, they had a very strong value year, Sam, of up 8% in a market up 24%. Um, and I
Well,
know,
I think, right now I can appreciate why you would say, you want to go for the growth, and the growth is where tech is and really nowhere else. But it does sort of spook me that if 6 of the last 8 years, technology as a sector posted price appreciation in excess of 30% in each of those years,
yeah,
whereas you look at the other areas of the economy and you say, well, why even bother being invested in them at all? Don't be diversified. But all I can think of is Brooke Benton, who once sang, it's just a matter of time. And so I think there will come a time in which those stocks that are very good growth opportunities just get overbought, because I think people are basically saying, I'm not going to worry about valuations. I mean,
yeah,
right now, the tech sector is trading at a 35% premium to its average 10-year PE ratio on forward earnings estimates, yet it's trading at something close to 65% on a 20-year basis. We did peak out last year at a 78% premium back in the middle of July, which was right just before we had that middling pullback, which really wasn't very much. But there will come a point, I think, in which investors say, like, don't even bother looking at history at all. And then I'll say, well, how do you know whether something's cheap or expensive?
I'm with you. We'll be right back. Money Mavericks. Cam is then going to get an earful from me on why reversion to the mean is not working, and there's reasons why. We'll be right back.
Hi everyone, I'm Veronica Dudo, and welcome to Buy,
Hold, sell. If you have the Russians that are going into Ukraine, the Americans and the Germans and everyone else in Europe is going to say, hell no.
If Russia doing things, logically was their MO, I'd agree with you. Yeah, Todd, why don't you get him on a phone call right now? Hello, you.
Hey there. Welcome back to Money Mavericks. We have Slinging Sammy Stovall in the hot seat today. And, he's one of the more famous prognosticators of the near-term future here in the United States stock market. Been only doing it for, a few years, 50 years. And his dad was only doing it for 60 years. I mean, these Stovalls are legends in my mind. So, Mr. Legendary Seer, why are you bullish on the market or not bullish on the market here? I mean, what are you projecting is going to happen this year after this big run we've had so far?
Well, I'm still a bull, but I call myself a bull with a lowercase b. I think it's going to be a good year, but not a great year,
Okay.
for a variety of reasons. First off, third year bull market. we've had 11 bull markets that celebrated their second birthday, but then 12 months out for those 11, the market was up only 2.2% because 3 of them slipped into new bear markets before the year ended. 2 more posted declines, though not enough to be called bear markets. 3 more posted increases of 6.5% or less. So basically, the probability of a three-peat is not in the cards. And history says you really only have a 1 in 5 chance of a three-peat or a double-digit gain 3 consecutive years after a market decline. Also, I find that first year presidential cycles, a good majority of them, close to 90%, have had declines of 5% or more in that first year, with the average decline being 17.5%. Now, that is what I would call a correction. It's not a bear market, but let me remind investors that it's taken on average only 4 months to get back to break even from a decline of up to 20%. And if we therefore hit a bottom before the end of August, then essentially we have the remaining months to get back to break even.
So you're Mr. Buy the Dip.
I would say, yeah, buy the dip, but also just be aware that volatility is likely to be on the ascent this year as compared with other years. Also, what I find interesting is that the market tends to do very well in anticipation of the first rate cut. I like to say that wanting is more rewarding than having, because going back to the Fed.
Is that just interest rates, or does it apply to everything?
Well, I'll let you apply that to everything. But certainly, as it relates to interest rates, the Fed started to be transparent with the Fed funds rate back in 1989, 1990 with Alan Greenspan. So looking at the 7 times that we had the last rate hike and then we waited for the first rate cut, the S&P was up close to 20%. Yet in the first 6 months after the first rate cut, the market was up an average of only 2%,
Yeah.
and a similar amount 12 months after the first rate cut, with an increase in the number of observations that experienced declines. So basically what I'm saying is I still think that there's opportunity. I don't think we're going to see PE multiple expansion because we're right now trading at a pretty hefty valuation premium. And while that's not a good market timing indicator, I think it does sort of represent a headwind for investors. So we got to go with the earnings growth, not necessarily PE multiple expansion. So I'm still bullish, but fasten the safety belt. It's going to be a bumpy ride.
Yeah, I'm with you. I mean, this concept of pulling forward earnings, to the point that there's no room for error. When I start to see earnings calls where they hit it, boom, and they hit it, and then they just miss a little bit, and then the stock's down 10%, that tells me that there's this thing called algorithms, which I looked today that 82% of the trades on the S&P 500 were from algorithmic trades. And those are momentum players. I mean, this better than anybody.
Oh, sure.
And so it's not a human making a decision. It's an algorithm saying, if this, and this is happening, buy this, and this, and keep buying it until it doesn't work. So, I think one of the reasons why history has repeated itself here in the last 20, 25 years is that's also when algorithmic trading got going. When it first got going, people were taking their PCs and moving into offices that was near where the internet feed was coming out of, so they could get a, half a millisecond, right? Ahead of the market.
Right. So by the time it would take me to sign on to the computer, they've already made 1,000 trades. So
yeah. I mean, so the market is not constructed any way, shape, or form the way it was 50 years ago, 30 years ago, 20 years ago. And I think we have to, if you're certainly a growth investor, you have to be aware of this. And we just use the Toby's rule of 10. If one of our stocks has essentially gone parabolic, and it's over its 10-day moving average for 10 straight trading days, we shockingly take profits on at least half of that position, particularly if we have capital gains, because that means the algos in my mind have just taken over. And there's no, it's going to keep going up until it stops going up. And then they sell all at the same time, but they're outside. They don't care. I think investors at home, if you just followed that rule, I mean, for instance, we were just totally in love with the quantum computing stocks. I lived very near the University of Maryland, and I had the neighbor of two neighbors who were presidents of public companies. They all went through SPACs, of course. And I got to know, what they're doing, and particularly D-Wave and Rigetti. So when they got down to like $2, when they got down to 75 cents last summer, we were just building 1% positions in those names and not thinking about them. Then all of a sudden, Rigetti is selling for $28, and it happened in 4 days. And we have subscribers and we have money management clients. The money management clients, shockingly, we captured most of that. We used sell stops, and the things finally fell in their face. Then they came back to $2. Can you remember, other than the dot-com days of in such a compressed time? I mean, I call it the Reddit Raiders. If we follow how many Reddit posts are on all these stocks, and there's a service that actually does that now. And if something triples in the amount of people who are on it, we say the Reddit Raiders are in there, baby. And thank you for keep buying this stuff, except that when it peaks and it's at like a 95 RS high, arrivederci. I mean, is that wrong?
No, not at all. I think a lot of investors who were buying into the meme stocks experienced that as well. That it's almost like a speculator who drops a crumpled piece of paper on the floor with a buy IBM or buy whatever the stock is that he wants to get out of, drops it, and in anticipation of the less knowledgeable traders saying, "Oh, that's what he's buying. Let's go into it." He's unloading it. So Jesse Livermore type of activity. But no, I think your rule of 10 is a very smart one, because bulls get rich, bears get rich, but pigs get slaughtered.
No question. But it's also intriguing to me, again, to talk about expensive lessons. I think they did a survey, at least on Rigetti, which we repurchased again, because it really is one of the leaders. They and Qubits are really one of the leaders in, and they're making $40-50 million in revenue now. It's not like Jensen Huang comes out and says, "Oh yeah, these guys in 10 years before this quantum computing." Well, I love Jensen. He's made this new house here is thanks to Jensen, but he's dead wrong. I mean, these businesses, it's just that they're pre-earnings, they're doing revenues, etc. Anyway, that was the point I was trying to make. Is when people at home, when lucky your brother-in-law said buy Rigetti at 75 cents, and it shoots straight up. I'm not talking like this when it shoots straight up and goes up 2,000% in 18 trading days. You just keep raising that sell stop, baby. You're not going to ever hit it at the right. I've never done that except for one time in my life. But when it goes back to $1, you're not going to be going, "Why didn't you tell me to sell?" Come on, man. You got to grow up. All right. So sectors. You love financials. I got that. What else do you love?
Also like communication services. Let me chat a little bit.
You can't talk stocks. I know that. You got to talk sectors, right?
Well, actually, I mean, I can share with you in 2024, the top 10 sub-industries, and there are 125 sub-industries in the S&P 500. But what I did was, as I had mentioned, let your winners ride. So what are the sub-industries that were the best performers last year that historically will outpace the market in the subsequent year? So auto manufacturers, no surprise with Tesla. Construction and engineering, AECOM. Consumer electronics, Sony. Consumer finance, American Express. Electronic components is Corning. Interactive media and services is Alphabet. Movies and entertainment, Netflix. Thank goodness for the earnings today. Oil and gas, storage and transportation, talking about a group benefiting from the Trump trade. That would be the Williams Company. passenger airlines, Delta, and then finally semiconductors. We have Marvell as our highest ranked stock in that group. Yes, we like NVIDIA, but we have Marvell as a 5-star and feel that has very good upside potential. So interesting. You've got
talking to the choir here, Stovall. Broadcom, Marvell, NVIDIA, Vertiv, everybody in that stack that is dominant.
Yep.
The 250 billion of spend, where like 75 billion goes. Maybe that goes into the land and build the structure, but everything else goes into the stack.
Well, you and I were talking before about how some of the old strategies don't work. You were talking about value, but a thought that could have come to mind was, well, what about diversification? Well, here's a situation where you've got actually, these top 10 sub-industries come from technology, consumer discretionary, communication services, industrials, financials. So you have a very diversified list.
And utilities. Sam, utilities are sexy. When was the last time that happened?
Exactly. So, more power to them, pun intended.
I'll be here all week. Tip your waiters and waitresses. I know.
That's right. And go for go for the veal, right?
Go for the veal. Yeah, that's right. Take the veal. Yeah, I'm prejudiced towards secular transformational change. And then really, always starting, with the miners in the 49er days, where you go with the picks and shovels, the actual stuff.
Levi Strauss.
Levi Strauss, right? Who made more money, going for gold or Levi Strauss? Also, the bridge makers did pretty well. All right, so we're positive for the year. I'm summarizing here, but you would expect a natural some type of 10% pullback, et cetera, to consolidate these gains. But the winners from last year, if their earning per share are hitting their estimates, they're still going to lead the parade. And now you're adding financials to this because they get the headwind from hopefully lower rates. And I'm going to get one thing from you. Where does the 10-year bond go here, do you think now?
Our thought is that it creeps back down to about 4.1% area.
Hallelujah.
Exactly.
Make that happen. I'll get another house.
So what is it? The rising sun?
Yeah.
So my feeling is that we are likely to see the inflationary trends move back into the right direction. Probably hit about 2.5% on year-on-year core PCE by the end of this year, move into the low 2.1% area next year. Interest rates, we think, are going to continue to slide a bit. I think one reason that the treasuries, the yield went up is you had a lot of foreign countries that were selling the treasuries in order to try to boost the strength of their own currencies ahead of the Trump inauguration. So I think that is something that's likely to be unwinding. Looking for double-digit earnings growth, but without the PE multiple expansion. And so, what is it? The trend is your friend until it ends. So right now you let your winners ride. And typically they do tend to outperform the market for the full year.
Yeah, I'm totally with you. Sam, when we have you back next, we're going to talk a little sports, not on this episode, but I am always impressed at how well you guys diagnose the future coming here and then sort of meld in what's happened, because these still are human beings, although my algorithmic people are not human beings. But
we will not harm you.
You're right. But we can understand as investors that why is the trend your friend? The trend is a friend because they have secular growth and make earnings from that. And then you can take some long shots on, like I say, we were talking about quantum computing, because the core of what you're doing is increasing in value, and they have huge amounts of cash, so they're buying stock back, most of these leaders as well. So now you've got two engines to appreciate. And then, let's take some flyers on quantum computing like Brigetti, or some of the new scale with the nuclear power plants, which we know they're going to have. It's just they are not going to be around till about 2028.
Right, but one thing that does not end up changing with time is human emotion. So once these share prices start to tumble simply because people are taking profits, then you're going to find that the animal spirits in reverse come to the front.
Yeah, what is the animal or spirits in reverse? Okay, but we'll wrap up on that because you'll have a pithy answer, I'm sure.
Yeah, it just means we're going to the dogs.
You're going to the dogs, okay. And with that, our Money Maverick and our soothsayer steer for the year, and we'll call it a day. Great to have you on, Sam. Thanks so much for watching, ladies and gentlemen. Hey, we'll be back next week. Cheers.